Hi, everybody. Sorry, we're a little bit late, but we're going to make up for it with a fantastic guest. And as you can tell, he has some really cool shades. And I don't want him to think he's the only one. So this is my Hugh Hendry impression. Okay, not very good. And I'm not going to button my shirt because at 70 years old, I think I'd lose a lot of people. Plus, I'm wearing a V-neck T-shirt that really looks like I'm a nerd, which I am, I'll admit. But we definitely have somebody who's not a nerd. He is Hugh Hendry, if you don't know, was not only a successful hedge fund manager who generated equity-like returns for many years with low correlation to the stock market. And he's also one of the most independent thinkers in the professional financial community. As you'll further witness today, he's also one of the more colorful and provocative personalities. He resides in St. Bart's. In fact, before he got his camera going the right way, we saw a view out his window, which is just spectacular. So St. Bart's, if you don't know, is down in the Caribbean. It's also known as Paradise Found. Now, rumor has it, Hugh, that you're a regular at one of St. Bart's most famous beaches, Grand Saline. Is that true, or is that just a vicious rumor, or maybe an envious rumor?
How is it? There could be more malicious rumors than that. Celine is a majestic beach. It's a natural public beach. I guess it has some infamy rather, which is it's a little bit nudist. Um, but I once a week I do a 5 kilometer barefoot beach run on Celine. So yes, your intel is correct.
Yeah, well, I would imagine that you do a lot of loops around that beach, depending on who's attending at one time. But yeah, I've heard it's pretty spectacular.
Well, believe me, there are more, there are more spectacular loops on beaches in St. Bart's, but they are to be found elsewhere. The loop on a Sunday night between 5 p.m. and 8 p.m. at the legendary Nikki Beach is a joy foretold.
Well, we'll have to live vicariously through you, Hugh. But I did want to let you know that I listened to your recent podcast you did with Darius Dale, another one of my friends. Not only did I listen to it once, I actually listened to it 3 times, and it was just as intriguing the third time through as it was the first time through. So that's quite a tribute to the quality of your discussion. And it's not very often that Darius is fairly quiet, but he was fairly quiet in that, and so that's the way it's going to be today too. I'm going to make sure that you're the star of the show. And he one thing that he was talking about that I thought, well, actually, that you brought up that I thought was really fascinating was your prediction, which is very timely right now, given all the budgetary stuff that's going on, that Donald Trump wants to be Paul Volcker. But instead of crushing inflation with high interest rates, what he wants to do is balance the budget and actually balance the budget through a recession. And I want you to just, if you still feel that way now, maybe because of things are changing so fast in DC and they're always mercurial with Donald Trump involved. But is that still what you think is going to happen?
Um, well, it's who knows what's going to happen, but it is very much implicit in the path, in the policy path that he has elected to take, which is essentially a full frontal rejection of the prevailing mercantilist model prevailing in terms of the last 40 years. Um, the ills or the disequilibrium of the mercantilist model, and the mercantilist model is one of a managed exchange rate and managed to optimize the surplus of the mercantilist nation. And it requires a reserve currency. It requires a host country, both for the reserve and for the ability to impose a fake price, if you will, on an exchange rate. No mean feat, quite a challenge. And when you when you pollute the universe of pricing, when one major significant price in the universe of finance is wrong, the entire system is out of sync. So dollar renminbi, dollar yuan, US China exchange rate has been wrong, I would submit, especially since 1994, which rhymes and coincides with the emergence of the NAFTA, another trade agreement. And the effect of having essentially the principal price between the two largest nations on earth has been a pollution in the intelligence of money and the levels or the elevation of American risk assets. And Trump via tariffs, now he's doing trade out of gone capital, but it's still the same sense of direction. But the reason why it has never been elected by Trump's predecessors is that it implies the death, or it implies the profound deflation of US risk asset price levels. US risk asset price levels are sponsored by Wall Street. Wall Street is an enormous political contributor. If we go back to Frank Baum and the Wizard of Oz, the witch is JP Morgan or et al., the East Coast witches. And the line is the effete politician who does what he is told. And boy, this is a very, very exciting new rendition of the Wizard of Oz, where that line's got a roar. And in roaring, he's roaring like a Volcker. And people forget the sheer audacity of Volcker. It was a different time, of course. Now we're going back 50 years, but a time when interest rates may be changed on a Saturday morning, and with a sweetheart message to the stock market opening on Monday, and Volcker had the audacity to tighten immensely credit conditions in a recession.
In a recession, I remember 20% interest rates.
Well,
I'm old enough. I was in the business about a year or two at that point. It was unbelievable.
And these weren't 25 basis point increments. These were 150 basis points.
100 basis.
And remember, because something which is very profound in markets is muscle memory. And the muscle memory when he was raising rates was the last recession, the 73 recession, which was, the Yom Kippur and the war and the first surge in the oil price and the rationing. And that was the most profound, deep recession since the Great Depression. So heavens, he was taking on, it was bravado, and bravado which history suggests was necessary. So I kind of would, in terms of the implied destruction of prevailing risk price levels, I would compare the two. I would compare them both in being either naive or courageous, and they will certainly both bring about change. So yeah, I would maintain that comparison, that analogy is still intact. The only thing, so I would say to you, and I said this in some of my recent letters, the US economy, and forgive me, I hesitate, I procrastinate with this. It's an analogy with a cancer victim, a cancer patient, and which is to say that the travails of the US economy are profoundly, I mean, you don't need me to tell you that, but they are profoundly serious, such that they would augur for a comparison with the stage 4 cancer patient. And survival requires extreme measures. And this clearly, and the path being adopted by the administration is deemed to be extreme. And I think the conditions validate the extreme nature of it. But any cancer patient, you get a different story from the nurse as opposed to the expert, as opposed to the doctor. The doctor tells you you're kind of going to be all right and you got to do it. The nurse tells you just how seriously awful the implications of the policy path you've elected to take are. And I'm not sure Trump has met the nurse.
That's a good analogy. I like it. But one thing that strikes me about that, and I don't disagree with it, but the stock market. mean, given the dire straits that you indicate the US economy is in, and once again, I don't disagree, but what's odd is where the stock market is, given those challenges, to put it mildly. And I would go so far, I mean, I imagine that you're at least aware of the fourth turning. Have you read The Fourth Turning is Here, Neil Howe's follow-up bestseller?
Yeah.
And I'm a believer we're in the fourth turning. I think it just completely fits. But what doesn't fit is the very frothy behavior of the stock market during this. Now, of course, if we'd had this conversation 6 weeks ago, it would have been a different tone. But obviously, the market has decided uh, that there's not going to be the pain with a Trump, paradigm shift that there was with Volcker.
Yeah. I mean, as you know, the market is essentially two components. The profound valuation afforded to this this disturbance in the universe, the AI, and then everything else. And household large blue chip names, many of these stocks trade at absolute levels prevailing 30 years ago. And for good measure. I am. It's an excellent observation because I'm cognizant of it, and I'm caught between diverse feelings or binary feelings, because I have just, if you will, explained one tale, the tale of the deflation that is inevitable when you withdraw the hot capital flows from surplus trading nations. Okay. Now, on the other side, what if the stock market, so maybe the patient didn't know, but the stock market was aware of the cancer. And it's a bit like there was a comment today. He's not my favorite, but I mean, I respect him. But Ray Dalio is like, it's like a ship, and we're really heading to the rocks. And I really don't give a damn which way you steer the damn thing. Just steer it away. Go left, go right, but change the course. Yeah. And
So what he's referring to, that he's talking about what I think what he's talking about is what I refer to as the federal fiscal financing fiasco, the 4F scenario,
yep.
which just doesn't seem to be getting better. You look at this latest budget that the Republicans have proposed, and you go, my God, it's if you use real accounting, real assumptions, realistic assumptions, you're looking at a deficit that's going to increase by $30 trillion over the next 10 years. If you don't, assume that the 2017 Trump tax cuts go away, which they probably won't, for example. And then you get all the, no tax on tips, no tax on Social Security, they're going to raise apparently the mortgage deduction limit up to 40,000, and so it's I guess maybe that's property tax deduction, but a lot of goodies being thrown at it, and some of these are campaign promises that Donald Trump made, but they are completely irresponsible from a budgetary standpoint, unless there was a time, Hugh, not that long ago, where we thought Doge might be maybe $1 trillion, never believed $2 trillion. And then you had, how much are you going to get from tariffs? That could have been an offsetting windfall. But I don't know. I mean, do you think that there's going to be significant tariff revenue that actually comes into the U.S. Treasury coffers?
Well, I think we're thinking about it incorrectly. That the malaise, all of the malaise, was the acceptance of disequilibrium. Okay. Economics is pretty lame, but at its most entertaining, it is the examination of a system seeking equilibrium. And typically, the drama comes because the system is far from equilibrium, and the narrative is we ponder on the return to equilibrium. But there is a constancy in the need to seek out and to gravitate towards the equilibrium. Okay. Now, this is a debate that goes back more than 100 years. This is the malaise of the gold standard. Gold, we could call it the sausage standard, but there was a monetary standard. And it was a standard which was designed to foster equilibrium. Like the greatest sin in an economic system are trees that grow to the sky. Trees kind of go that way, but there are limitations. Again, there's mean reversion, et al. There was a flaw in the gold system. But before doing the flaw, what was the system? The system was the exchange and disintermediation of gold reserves between sovereign trading partners. And the gold represented high-powered money. And as a sovereign, if I'm doing correct things, if you will, if I am collecting claims on the rest of the world's prosperity, then the rest of the world is sending me high-powered money, which sits as a liability in my private banking system, which then encourages my system to take more risk and to add assets to the banking system, which are loans, credit creation. And that credit,
which was basically the US in the 1920s, right?
I'm discussing US in 1920s, yes. US 1920s would be deficits to GDP would be surpluses to GDP would be comparable with modern China. And that process of transferring high-powered money to the country doing well was a process to encourage the economy to overheat. And as it overheats, as it gets price inflation, predominantly wage inflation, it boosts the demand for overseas products and services, and we get a return to the mean. Equilibrium is restored. And that was thwarted by, if you will, it's always by do-gooders, but the New York Federal Reserve took the decision that the US economy it didn't need the steroids of this high-powered external money, and they would reject it. But in rejecting it, they cast in cement, if you will, the travails and the mild depression in the rest of the world, and they broke the system. So the US ran surpluses forever, if you will, in that environment. And that's exactly what the Chinese have done, and other nations, but infinite surpluses. Now, an infinite surplus requires an infinite rise in debt. I mean, it doesn't, but the implication is an infinite. If you believe that social democracies will do everything to avoid the horrors of mass unemployment, then inevitably, if you agree and if you do not put barriers in the way of an international trade system which perpetuates surplus, then by implication, you are accepting that in host countries, debt to GDP is on an infinite or a loop which will bring down that nation. That's where we were. And Trump, by signaling that he is willing to take on the deflation, if you will, of risk asset prices, is saying that the debt to GDP and its path will flatten out, will improve. But the only way, you see, I think where I disagree with Druckenmiller and Dalio and whatever is they believe that the US deficit was a function of incompetence and reckless political behavior by domestic agents. And I believe it was fostered upon them. You know, I just posted go on my Instagram, folk, if you want to giggle. I posted this picture of this really, really hot lady in a bikini. And I don't even know what I said, but it was kind of existentialism. It's like, you think you're the player, but you're being played. Okay. And the Druckenmillers and Dalios think the US is the player. And I differ. They've been played by a system, the flaw of the Bretton Woods. I mean, Keynes said, don't do this. You're creating a system which will perpetuate surplus. and you will break the system.
So, something a key part of what you're saying, just so people understand, is that the Chinese currency has been artificially repressed. It should have appreciated significantly, and that should have been the equalizer.
Yes.
And that wasn't allowed to happen. So the
So,
distortion has continued and continued and continued.
and people go, yeah, big deal. Okay, so first of all, um, we exporting and surplus has a cornucopia of positive feelings. It's like, oh, good on you. You must be doing something right, you know? Why would you export? You know, it's not the be all and end all. We've moved a million miles away from David Ricardo in the 18th century, you know, intellectualism of trade and the comparative advantage. You kind of been there, done that sort of thing. You trade for a reason to enrich your society. Okay. Now, the system that let's just pick on the Chinese. It's not a democratic system, and it has economic and political overlords, and they determine the level of prosperity. And the Chinese today, the citizens, I have only amazing, wonderful things to say about them, but they've been unlucky because they're allowed to be prosperous and way, way, way more prosperous than the generations that preceded them, but they're not as prosperous as their endeavors, as the productivity of their endeavors would imply. And prosperity is being denied via the exchange rate. If you only required 4 renminbi to buy $1, it would be a hell of a lot richer. And your purchasing power of overseas goods and services would be immeasurably higher, and your demand would be higher. Now, we see this in the abysmally low consumption to GDP statistic, right? Now, that can be a dirty statistic. Some people have some government spending in that. You take all government out, and you're in the low 30% of GDP. Consumption
versus about 70 in the US, right?
Yeah. So consumption in China, in round figures, is about $3 trillion. And it should be like, we're missing, if you will, 40, not, what did I say? Trillion of additional Chinese private consumption in the world, right? So, and because that's missing, we have a world of surplus savings, because again, one is the other, right? So the Chinese in the model that they have elected to pursue for so long sacrifices consumption domestically in China for savings pools. And that savings pool is then like tipping Mont Blanc into Lake Geneva. You know, like it creates this cascade higher in asset prices. It's all linked. Oh, absolutely. I mean, I sound mad, but I know it sounds mad, but that has been the prevailing macroeconomic situation for 40 years. And I want to say to you that macro hedge funds and macro models and the models of Charles Kinderberger, manias, panics, manias, etc. You know,
I remember reading that book a long time ago.
A long time ago, like me. And that was almost the handbook to running a global macro fund. I ran a global macro fund. And it told you crisis. The last time it was appropriate was the Asian tiger crisis in the late 90s. And since then, we've lived in a new macro environment, which is the one I've just described. And I'm saying to you that system, which has prevailed for 40 years, and which has defined and determined money, that system is potentially being put to the knife. And
okay, so do you think, I mean, certainly when the Independence Day or Prosperity Day, whatever he called it, was announced back in early April, that was a radical shift. But with the tariffs having been moderated, theoretically, assuming that these agreements, the 90 days elapse and the agreements are at the kind of level that we're talking about now, which would be, I guess, an overall tariff increase of about 18%, 10% on most of the rest of the world, more like 30% plus on China. Is that going to be enough to rectify the situation?
No,
Liberation Day. Sorry, that's what he called it, Liberation Day.
um, this is the arena of politics. Yeah, so this is the damn stupid book. The art of the game, the deal,
Part of the deal, right?
Um, I'm trying to look beyond those optics, and these are news bombs, which are going to vary in their degree of being downright awful to being damn interesting. But I think a different path has been chosen, and time will tell. But so let me confess to you, I have now endured a period exceeding 2 years of being wrong on long duration U.S. treasuries. That I am attracted to mean reversion, but mean reversion in the four compass points of the macro compass, right? So the S&P, treasuries, alternatives like gold, Bitcoin, and cash. We had infamously, or whatever, we had profound mean reversion in the S&P in March 2009. It fell 2/3. And mean reversion, when if you can avoid the mean reversion, the other side of it is incredible. And the movement in, if you take dollar TLT from 180, it's halved, more than halved. I am intrinsically attracted. I feel an onus of responsibility, a burden of responsibility to be long one of my four compass points when the price has halved. But it may have halved, but it's not rising. And with the thesis that you're exploring with me, the thesis that I am discussing would make me very bullish on treasuries. I think implicit in these actions is the creation of a new treasury Bund. The German Bund is the most exalted sovereign piece of paper. There's just not much of it because they haven't run deficits, and because the ECB has hoovered up almost the entirety of the float. I think only 18% of bunds ever issued are actually allowed to freely float in the world. I think the steps being taken by Trump et al., his administration, would make me envious, want to own treasuries, because implicit, and it's touching upon your notion of tariffs, implicit in tariffs, what you are doing is you are extending the tax franchise of the United States, and the tax franchise continues beyond the border of the United States. Right? You've massive, the sin was in allowing the reserve currency to be a public good. That you could come in as a foreign entity and use pristine US Treasury capital and not be charged for it. And the Besant et al., the genesis of intelligence in this administration is like, we got to change this. Now you change that, and you are increasing the tax revenue of the US administration vis-a-vis the rest of the world. So given a choice, because, you might not like, double-lined, big, huge fixed income US manager.
Choking on left, right?
Yeah. Really underweight long duration treasury. Okay. But you still got to own them, right? You're just underweight, right? So whatever.
Well, you're touching on a hugely important point, which is a fierce debate, and that's the tariffs. Who pays the tariffs? And I know the Trump administration is very adamant that it's paid by the foreign exporters, whereas a lot of economists believe it's going to be paid primarily by the U.S. consumer. That it's basically a tax increase in drag.
You're in a logic trap. You're in a logic trap. It's not going
to me. It seems like it's going to be a blend.
No,
it's going to be some of
this is in the early 1980s, there was a British band from Liverpool, Frankie Goes to Hollywood, and they had a very controversial song called Relax. I'm not asking you to relax, but they had an album um, produced by this genius guy called Trevor Horn, and it's like a dance techno opera following on from the tradition of rock operas in the 70s. But anyway, and the
Freddie
song Two
Mercury.
Tribes. There's a song Two Tribes Go to War, and the host deficit nation of the world has gone to war with the other side. Okay, and the balance and who pays for this will be determined in terms of sovereign checks and balances. Okay, the US is saying we are not going to run a deficit anymore. Right? We want a system of equilibrium whereby we're not perpetually in deficit. Okay. Now, so he goes on his bric-a-brac tour of Arabia. Yeah. Goes to meet Alibaba, if you will. And they are a creditor, sovereign creditor, surplus nation. And they're beginning to get it. There's a big lesson coming out of those round of meetings, which are again positive for markets, which is the sovereign. So forget consumers. The sovereign leadership goes, this guy's serious. We have to get the deficit down. Okay, so he comes back with what, $1.2 trillion of purchases. So, and the Chinese are going to look at this, and the Chinese are going to go, we just gotta buy stuff, right? So the implications of that, if this was a micro rather than a macro show, we would discuss how you have to own Boeing, because that's just like an easy one. It's like, okay. Then there's like soft commodities. Okay, we're gonna buy tons of them, and then it's like America will have like natural gas.
Natural gas. I was just going to say natural gas,
Gas is
LNG.
being priced at nothing because on the previous course of economics, America had an infinite supply of natural gas. But if you come into a world where the mercantilist says, shit, we have to balance with these guys. We've got to buy something. We need the energy and AI, etc. So, we're going to buy energy.
To me, what you're describing right now is much more powerful than the tariffs. That's what I think is the biggest deal. It's the purchase of U.S. goods and things that we really do have in enviable quantities, like natural gas is a great example, but also to invest in the country too. I mean, I think some of these, not all of them will happen, of course, but I think there is going to be a lot of reshoring of production to the United States, and even China doing what Japan did in the 1980s, where they built auto factories. I think it's an interesting question whether they will be too paranoid to do that. Have BYD, although they're starting to do that in Europe, right? And maybe if we don't put tariffs on BYD cars that are made in America, the BYD will open a big plant in Alabama. Do you think that's feasible?
Yeah, I do. But the challenge here is not to get drawn into newspaper articles and headlines, financial TV. This is not micro, it's macro. And at the heart of this, Michael, so the modern equivalent of Keynes is someone we were talking just before about the group that you hang with. I'm sure, well, first of all, I'm sure you have immense respect for it, and you may well know the esteemed Professor Michael Pettis.
Mm-hmm. Know of him.
Okay, well, I'm very lucky to say I can count him as a friend, and I think of him as a modern Keynes. And
is that a compliment or is that a criticism?
That heavens! My goodness! That is a compliment. The Keynesianism is something distinct from the man.
I've always thought Keynes got a bad rap. I think Keynesianism has been improperly applied, but we don't want to go down that side road. But I'm
No one
agreeing
had
with you.
more no one had more respect for Keynes than Friedman, you know. But anyway, Pettis has been explaining I'm kind of like I'm the poor man version of I'm the dirty version of Michael Pettis.
I'm proud of it.
But his book is Trade Wars, Class Wars. That's where I was going to. Trade Wars, Class Wars, and so again, this whole notion of the cancer, the stage 4 cancer of the United States, which is, oh my God, on this path there's another 30 trillion of dollars of debt to be issued. We're going to kill the patient. And then the mistake I'm seeing is people are getting drawn into bean counting. Well, what if we have this tax or we have this tariff, and you count it up and what happens? And I'm saying, no, it's a feint, it's a pivot. And one of the principal pivots is the natural, what do we call it? The natural rate of profits and interest, and the natural rate of prices. The Swedish economist from God knows.
Wixel?
Wixel, indeed, the natural rate. Now, I would say to you that the natural rate of profit globally is very, 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 very low, which means there's no investment demand for productive capacity. So there's huge, huge capex in China, but without a profit motive.
Which is probably why their stock market has been a dog for so long.
Indeed. So China has produced exemplary GDP growth, but at the expense of wealth. Okay. And the challenge is to do both. Okay. Imagine a system where you had an extra $5 trillion of demand. So that's 5% of GDP, global GDP. And that would grow in line with nominal GDP. So what is the present value, if you will, of $5 to $6 trillion growing at 5 to 6% nominal? That's a bloody big number. And that's what we're gaming for here. We're trying to bring that on top. This is not a devaluation of the dollar. This is a revaluation of the Chinese currency, which enriches their citizens. It gives them wage price gains. It creates wage price gains for the global labor pool. We're in the world of Henry Ford. We're fighting a preposterous dogma that wage rises are bad. Wage rises are bad if you are pressed up against full productive capacity. You're not there. You haven't been there in 40 years, right? If you bring on that $5 trillion of additional Chinese consumption, guess what? I'm looking at my business and I'm thinking, I need people. I'm thinking I've got to invest. And I'm thinking I probably got to invest in the US, yeah, given the relative exchange rates. The trajectory of the US debt and the deficit will be solved by solving for the profound lack of demand in the global economy, and we unlock it by restoring trade equilibrium. That's what I'm saying, and I think that's what's so exciting about and that may mean for 3, 5, 7, 8 years, 10 years that stock prices kind of go nowhere. It may mean that they fall 60%, but point to point, your compound growth rate is 3 rather than the average of 10. And I would say to you...
So kind of what happened from 2000 to 2013 or from 1966 to 1982. We've had those periods before. And that does, because one of the things I wanted to bring up is you brought up you discussed with Darius that you thought that pretty much all U.S. financial assets are overpriced. Now, presumably from what you said earlier, you don't mean bonds, but other financial assets. So obviously the stock market. And if you think the stock market at some point can go down significantly, that's an implication that it's overvalued, which of course virtually every metric you look at is screaming that the stock market is too high. but it doesn't go down, or if it goes down, it just goes down for a short period of time, then it comes roaring back. And one of the points you made is that one of the biggest drivers of liquidity in the United States is the stock market. So with the stock market having done what it's done over the last 6 weeks, are we back into a situation where there's excess liquidity? And is that a challenge for inflation? Is that going to avoid a recession? I mean, do you have outlooks on inflation recession right now?
Sure. So I saw like a little pop-up, and it was like, what is trade equilibrium? And I'm gonna answer that question and answer your question. Okay. So trade equilibrium, unless I just imagined it, trade equilibrium, it would be the notion that over 40 years, the US would have a pretty strong probability that kind of like maybe 10 or 12 of those 40 years, the US would run a surplus, that China would run a deficit. But we got 40 years where it's no like deficit and surplus, right? So that is not trade equilibrium. Equilibrium is you push one way into like lots of surpluses, and then you get pulled the other way. That's equilibrium. It's a man of war, like two tries pulling on a rope. Yeah. Sometimes you're stronger, sometimes you're weaker. That's trade equilibrium. When it's just one team and they're strong, you're pulling the system over. So again, think of it as, I would say bullies, but it's economic bullies, but you are having a huge difference. Now, liquidity. Liquidity. And now I've got like this guy, Jeff, I'm now talking to him, but anyway, Jeff, later, he's talking about free markets. Liquidity. Liquidity is a term which enrages me in its misuse. But you got it head on. And so my compliment to you.
Well, I was just quoting you, so.
Oh, well, that's where you got it.
How can I be wrong?
Well, now my ego is out of control. So for me then, liquidity is rising risk asset prices, and liquidity is destroyed when prices fall. So what I mean by that is you have a balance sheet, you have assets and liabilities, and so whenever we talk about US debt to GDP being very, very high, that's true, but the accounting implication of that is that our wealth is also very, very high, because because it's an identity. Yeah.
So based on that thesis,
when stock prices are going up, you've got asset prices which are going up, but your debt doesn't go up.
right?
Okay. And so that makes your lenders and those who are collateralized lenders to you, they start calling you saying, you've got more margin, I can extend you more credit. And so that is liquidity that you're generating. And of course, that works in the reverse. It's like an interactive broker's account, yeah? Risk asset prices go down, and you get a margin call, which means you got to sell something. That's
which we had 6 weeks ago. We had a global margin call for a few days.
But what I mean by that, so no one has a model, right? There are no models. There are no proprietary models. It is all BS. Liquidity is a BS thing, right? Prices going up, liquidity is good. Prices falling, liquidity bad. Okay. Now, the S&P from the beginning of 1980 to presently, now that's a hell of a long time, but the S&P has multiplied 60 times, 60. Oh, that's a lot. Oh, that's well done, Captain America. Bloody well done. But that really is a lot. And as we know, valuation metrics assessing the stock of valuation to the flow of GDP, we're at metrics which are extended. And I would say to you that 40 of those years have come from a system where the persistent trade surplus. So I've got $1 trillion flowing in, okay? And if I don't sterilize it, that $1 trillion is going to bid up my renminbi. But instead, I take your trillion and I push it back at you and I buy $1 trillion, okay? I've neutralized and I have prevented my private domestic consumer getting richer. But I've kept my ambition, which is the persistency of surplus. Now, I've just put $1 trillion of liquidity back into dollar assets. And I've probably bought the risk-free cash bill. Now, the risk-free cash bill, I'm going to go into the euro dollar system and use it as collateral, and I'm going to earn a rent on the American dollar. And that euro dollar system, which is a pawnbroker, is going to extend credit to private equity, to hedge funds, to everyone to buy assets. And so I say to you, no surprise that the S&P went up 60 times, because within that period, we created a paper printing machine. And it was not called the Federal Reserve. It was not called quantitative easing. It was called mercantilism and the avoidance of equilibrium.
Well, you brought up the Eurodollar system. That's one of the things I wanted to talk to you about. That's a huge topic, and you're one of the few people that really studies that. I think most Americans ignore it. Do you know Jeff Snyder, Eurodollar University? He's a guy I've listened to a fair amount. He talks about it a lot, but I don't know that we have time today. I mean, did you have like a 1-minute overview of the Eurodollar system, how it works, why you think it's important?
Well, so if we don't have time, let's do the teaser. Let's get people ready for part 2, because a big component of the new administration is digital currency, is Bitcoin. Yeah, I mean they've gone that way. They've said #1 priority, the US is going to be the Bitcoin center of the universe. And when you do the kind of things that I do, whatever that is, it's all tied together. There is a very compelling logic that the US is going to marry. I mean, this already happens, but it's going to be officially endorsed. You're going to fuse the Bitcoin and the treasury. When you do that, as everyone is like, yeah, that's called a stable coin.
Yeah, I was going to say that. To me, Tether is the middle of that fusion.
It is.
And that they're going to be just a voracious buyer of treasuries, and God knows the treasury market needs voracious buyers.
Okay, but the US is going to become the repository, the global center of stablecoin issuance. Like Europe cannot have a stablecoin because it would be dependent on the Bund. Europe has to do full political union, which is not going to do, right? And so what I'm talking about is you're also potentially talking about onshoring the Eurodollar system. The Eurodollar system came out of the late 1960s and was a system which it printed US dollars outside the sovereignty and the regulation of the United States. And it ended up being the principal issuer of US, if you will, credit coinage, digital credit coinage. I call it digital in the sense, not like Bitcoin, but just that it was a digital ledger. And I think the plan is to do away with the Eurodollar and have monetary policy conducted via stablecoin, US stablecoin, which makes the world a buyer of treasuries independent of trade surplus. Okay, so there's always going to be the funding, and then you'll have a huge gold community. Let's get them really annoyed, but gold. It's a bit like war. War is it? War is war. What is it good for? Gold. What is it good for? Yeah. So okay, let me answer that question in the affirmative. We've had modest amounts of annual price inflation for 50 years, but compounded, that's a lot. And by owning gold, you have more than preserved the purchasing power of your wealth. But that is not something which is exclusive to gold, because equities have done that, art's done that, classic cars have done that, et al. That's what it's good for. That's all it's good for. Now, the notion of gold as a sovereign reserve and that being a good thing, I take issue with that. I think that's nonsense. Okay. Like, kind of, if you will, bragging about having a lot of gold in the reserves which back your fiat currency. We are not in a gold system, and therefore I'm unimpressed. Let me give you an example. I think the second or third largest hoarder, sovereign owner of gold in the entirety of the universe is Italy. And Italy doesn't have its own currency. Wasn't trusted, even with the second greatest holding of physical gold. People are like, I'm not owning the lira. I like top 5, top 6 biggest holder of gold in the world, Turkey. Have you seen their exchange rate? So I think that this sovereign ownership of gold is a nonsense. Now, and let's be crazy, right? I'm the US, and I swap my gold reserves for Bitcoin. And let's say it's a ledger, and I go, let's do it. Boom. And boom, it happens, right? I would do that because I think, and we don't have the time to go into it, but the Bitcoin total valuation is 1/10 of the capitalization of gold. 2 trillion versus 20 trillion. I think Bitcoin will continue its meteoric expansion and price expansion until they trade pari passu. That Bitcoin has a 20 trillion valuation. So I think, which is to say, I think Bitcoin could trade closer to $1 million. So let's say I'm the sovereign, I'm the US sovereign, and I switch, and I can, so preposterous assumption, with no trading costs, I can swap one for the other, and gold, and Bitcoin goes to $1 million. Now at that point, you have oh boy, do you have a reserve asset? Because the US at that point would have a reserve asset, which would represent about 2/3 of all fiat cash, dollar cash in issuance.
They need to do that conversion relatively soon. They can't wait until it's way up in price. I mean,
you know what? I ain't waiting, and I don't think this is going. I think it's going. I think it's going through. I think we're going to make it's going to. You're going to see explode. Who knows? Who knows? Short-term movements, and the vicissitudes of the mind.
Well, we got a bunch of questions that are queuing up. That's really great stuff. And I do think we need to do a follow-up, because I could talk with you for 10 straight hours, and we probably would have nobody listening, but it would be fascinating. So let's let our people ask some questions. Who do we have besides Jeff? Or do we want to leave with Jeff? Jeff, what's your most pressing question? Brad, do you have somebody else?
I don't know what my most pressing question is. Too many things too fast. I will ask, were you talking about withholding interest on treasury bonds? Was that what you meant when you were talking about whatever you were talking about faster than I could follow it?
Well, Jeff, forgive me, but such is the nature of the format that we do get compression of ideas.
I know.
To short monologue. I'm sure you're free to watch it back, and there'll be a transcript. I would have preferred a withholding tax on sovereign holdings of dollar risk assets. As it is, I think the trade tariff is probably as effective. The withholding tax would be more elegant. I think it's still out there, and I think we may well see elements of a withholding tax being charged. Yeah,
it's easier to manage too, I suspect.
It is. I think. So why not? It goes back to, I was suggesting the Volcker comparison. One of it being the audacity of being willing to play with the fire that to remedy the ills of the economy, you may, the risk assets may suffer, right? You may be the author of a big sell-off in the S&P. And as a politician, do you want that authorship? I think they see the relationship between the withholding tax on capital and the direction of the S&P. I think they see that being closer together than the trade. And so I think there's a bit of gamesmanship in what they're choosing.
Thank you, Hugh. This is fabulous. And mercantilism is definitely the avoidance of equilibrium. I love that.
Okay. Well, great. I'm glad you got that.
If anyone else has a question, you can raise your hand using the react button at the bottom.
We got a little lag. I've got one that was relayed to me by an analyst from a very successful money management firm in the Seattle area. And he follows you very closely, Hugh. So you got a fanboy there. And he's wondering about the correlation of gold and NASDAQ to Bitcoin, and which does Bitcoin follow in the future?
Well, so there has been a very positive correlation. Again, we could talk about liquidity, that risk asset prices have gone up, and therefore more margin has been extended by the system for the purchase of everything. Okay. And we talked about, I think you were quoting me, and I've said the overvaluation of everything. Within that overvaluation of everything, I want to say in a crazy world, Bitcoin seems a bit less crazy by comparison. So people will find that an outrageous comment. So gold has thousands of years of precedent, which cannot be dismissed. But I'm a risk guy, and sometimes I've got to make faster decisions. And so I've got to play with 15, 20 years of data versus gold having thousands. But 15, 20 years of data in terms of the existence of Bitcoin, we beta tested it. I mean, we threw a lot at that system. And
I'll tell you, I've never seen another asset class that's gone down 80 to 90%, like Bitcoin's done a couple of times and then come back and made new highs. I mean, I think that tells you right there that there's some intrinsic demand, something different than other assets in the past.
Yeah, so there's that, and then there's just utility function, and then there's just this notion that the plumbing of banking changes, that at the 1929 peak for stocks had a technology which was the telegraph, and Mrs. Jones from Palm Springs was in Fifth Avenue at Saks, and she wants to buy like something really expensive, and you could, with the technology, hit the West Coast and they say, yeah, we love Mrs. Jones, give her the money, and we laugh at that technology now. But what I mean is, imagine trying to explain to Mrs. Jones about Bitcoin, but Bitcoin and digital and what that will do to banking in the future. It's all about, the principal cost of the banking system is one of mistrust. I don't trust your credit. I don't trust your asset. Now, I'm in St. Bart's. I own property in St. Bart's. I have euro denominated debt issued by French banks. And the process is, Mrs. Jones would recognize the process from the 1920s. It hasn't changed. And it's the trust thing. And imagine you tokenize property. I mean, we're going to tokenize treasury issuance. There are amazingly fantastic things happening in the world. We are going to be able to see where every cent of money raised by the US government goes, because it's going to be tokenized. Incredible. So we're talking about
quite an experience.
Yeah, but the revolution in banking is not going to involve gold, and so I just think that Bitcoin does everything that gold does. In some respects, does it better in terms of portability, and very much is going to be at the forefront of the changes in banking that we can't even foresee. And so I think it is a reasonable assumption to believe that Bitcoin will trade at the same capitalization of gold, that gold is right, if you will, that gold should be $20 trillion. It's the grown up. We know how it trades, and it's trading accordingly. And we got this new thing, and we're like, well, yeah, I think you could trade like this. And so, in a world of overvaluation of everything, heavens, I was on a show a week or so back, and I was like, the trade for this, I'm sitting in this majestic house, $35 million, beautiful house. It's a commercial property. I rent it. On Thursday, I'll be leaving, and some rich people will be coming in and paying me money. Okay. I earn rent. So I get, it's 35 million bucks, and I get a 3% real yield. Well, yeah, 3-ish, just 2.5% real yield. Not bad. But as a trade, why don't I sell it? I got about 6 million of debt. Okay, that I have to pay that off. Why don't I put 10 million into Bitcoin? 10 becomes 100, baby. Now, but on principles, I'm not. I know what the value of my property is because I can deduct. Like you have this conversation with people who are not in finance, and they just think we invent house prices. That house is worth 100,000. That house is worth 30 million. There's deduction. You and I, we can deduce the value of everything. And so that deduction leads me to this preposterous notion that Bitcoin could be 10 times higher. Gold, to my mind, I can't deduce how it could be 10 times higher. It's trading what it should trade. 10 times would be, I'd have to assume the imposition of an externality, which is the system just became completely crazy. Why not?
Well, in some ways it's headed that way, but that's another topic. I know we had a question that just popped up.
Yeah. This comes from Jim Tiger. Would Congress have to approve the exchange of gold for Bitcoin?
Yeah, I mean, things like that. I'm not the guy to ask that. I mean, I'm your pole dancer. I'm your provocateur. I'm just here to get you inflamed and get you curious, or get your mind like popping extra molecules and all that stuff.
It seems like these days that Trump can do pretty much whatever he wants. I don't know if you've seen the chart of his executive orders compared to every other president. Off the charts. I think he's over 100 now. Nobody else is close.
I think it's a question for Steve Bannon. He seems to know the answer. And again, how these things, if you told me 9 months ago, I would be extolling, and believe me, I write on Substack and Patreon and all that stuff. And every letter is, I'm Trumpian. And my friend's like, oh my God, what the hell? Has happened. There was a kind of Me Too movement, and you couldn't be like if we all had a label, we'd want the label to say Ayn Rand kind of thing, like finance people, like, we all want to be John Galt. And there's a John Galt movement is happening. I'm incredulous. Is happening. And you weren't allowed, the super state had won, and you couldn't have these conversations. You couldn't accuse the Chinese of running, a mercantilistic system. You couldn't make those allegations. Now you can. I'm like, it's fantastic.
Okay, Hugh, we should probably wrap it up pretty soon, but we've got one more question from your fanboy that's a pretty good one. Will Trump 2.0 lead to the closing of the capital account for the U.S.? He suggested in past interviews that this is how the U.S. could fix its wealth inequality issues, but would be very tough to do and cause a massive recession. As a reserve currency, can you really do that?
Ask the Chinese. Like, they've done it for 50 years.
But they're not the world's reserve currency. So and they maybe would like to be, but they want to control. Yeah, they want to have a closed capital account, so it works against their ambition.
Okay, so I like your logic, because let's take that logic. Because the Chinese would go, like Asian small cigarette. We're just going to trade with someone else. Well, good luck, because no one else has the reserve currency. Why? Because no one else is willing to spend 1.1 stupid trillion US dollars on boats and missiles and drones, right? And no one has the political courage to have an open form of, I mean, I know we're Trump, but like judges, courts, contract law. You like, you think that, because we thought that the euro could be a reserve currency. You think Europe's going to accept running a trade deficit for the next 50 years? It's going to accept the absolute obliteration of high-skilled labor? It's not, you know. So, and so let's end on certainties. The US and Trump and the art of the deal, pick a fight that you can win. When a deficit nation goes up against the surplus nation after like 40 years of disequilibrium, paradoxically, all of the power resides with the deficit nation. Because you had it bad for 40 years and the pendulum's going to swing your way. So in 1929, the US was the economy that suffered the what, 25, 30% real decline in GDP. UK didn't. UK had tough time, but not to that magnitude, because it was bugger's turn. So Trump and the US have chosen a fight that they will win.
I agree with you. Great stuff, Hugh. I think we better let you go. It's what time is it there? Is it about 5 o'clock, 6 o'clock?
I have no idea. Yeah, about 4, I think.
Cocktail hour anyway.
Quarter to five.
Yeah, definitely the cocktail hour. So thank you so much for your time, and let's do this again. It's been fun. And how do people track your letters? You refer to your letters several times.
Yeah.
Tweets.
So Substack. I mean, Substack, Patreon. Substack is better than Patreon. And then I give previews on my Twitter X. So Hendry at whatever it's called @ Hendry_Hugh. And then if you want entertainment, if you want visualization, I'm on Instagram and I'm on YouTube, and Eclectica was, as you said, uncorrelated, weird ziggy-zaggy returns that made money when risk failed, and risk just largely doesn't fail, but the cost of, so I was, if you will, an insurance contract where rather than you pay me every year for fire insurance, I gave you a check. I mean, I gave you like 4% of the value of the property back every year, and then if the property blew up, I insured you.
When you had a spectacular 2008, right? Weren't you up like 30-40% 2008 when the world was getting crushed?
Yeah, but obviously there was the the Big Short, which was largely 2007. Again, in my world, I had that trade, and I had a custodian bank that forced me to close that trade in March 2007. My life is way too interesting. But so I'm an artist. I believe I believe there are other ways of seeing the future as opposed to being linear in your construction of mind and thought.
I don't think anybody would ever accuse you of being a linear thinker.
Yeah. So so I'm out there, and I'd welcome all the good folk to come and say hi.
Thank you, Hugh. It's been great stuff.
Thank you.
You lived up to your billing, and that's not easy.
Well, like when it's a good stage, I tap dance. When it's a boring stage, yeah, it's hard to tap dance. So thank you for the beautiful stage. Okay.
All right.
Thank you,
Hugh. We'll talk again soon. I'll say hi to Louis and Grant for you.
Okay. Thank you.
Thanks. Bye.
That would be a good one. Get the two of us.
Yeah. Okay. Well, yeah, and yeah, I think for sure we could do here soon is Louis and you. That would be quite the interesting chat.
Yeah,
because he has a very different view of China than
very different view.
May be aware.
And the hard thing is to have the pushback. Nobel economists get a really easy time because the journalists have no idea what they're talking about.
All
Anyway, I'll let you go. Thank you.
right, here. Have a good evening. Thanks again.